Thank you. Well, the big story of the day obviously continues to be everything that's going on with the IT stocks here in India and obviously around the world. Now, to understand this, let's talk to someone who's looked at IT companies for many, many decades as an analyst. Now, of course, he's on the investment side, he's running his own fund. But of course, he's someone we turn to very frequently every time we want to understand what's going on with IT. Sandip Agarwal, fund manager at Sowilo Investment Managers, is with us. Sandip, good morning. Thank you so much for joining in. This Friday the 13th, this has come true. It's actually feeling like Friday the 13th when you're talking about technology, right? What's going on, do you think? Let's start with the global picture. This whole absolute worry that AI is going to completely break software company business models. What have you made of all the noise around it?
Hey, hi, good morning, and thanks for having me on the show and the good preamble. But so let me put it this way, so what is happening is that, if you see after 2003, the hardware cycle has not kicked in. And hardware cycle has actually kicked in after 2022. So that is the reason you are seeing all this GPU sales going up, NVIDIA and all. And all numbers are there. So you can see that, like they're from 0 to like 100, that is the kind of growth we have seen. So I think this hardware cycle will continue for some more time. So there will be good time for hardware, followed by, a good, decent time for even software services. The reason is that, we will have to just reskill our workforce and redeploy. So there will be a pause of 3-4 quarters, which has always been there in the previous disruptive cycle. But this time we have an additional challenge that, the efforts will get cut by 20-30%, at least when they come for renegotiation. And hence, every year, if you assume 20% coming for renewal, 20% cut in effort, so we are at 15-16% kind. So we are losing 4-5% on the overall revenue growth. Even if we bring in 10% new growth, we will be net 5-6% growth. So this industry will have a lower growth for some time. But I am totally, not at all of the view that, we will have an impact on the economy, will have impact on the job and all those things. I think those cascading effect will not happen. But yes, we are in for a lower growth for a longer time in the sector. And the worst get impacted will be the software because they are broadly annual renewals. So whenever they come for renewal, there will be massive slide there. So, and that is the way we have seen the impact on the stock prices also. The hardwares have done phenomenally well. The softwares have been worst hit. And the software services are hit more, not because of, the growth or crack in business model, but because of the multiple which we are assigning, because everyone now has started building in a lower growth for a longer time. So I think this is what is happening on the overall space.
Yeah, the problem is that, Sandeep, I mean, how much lower growth? Because over the last, I think several quarters, last couple of years, I mean, we've been struggling with 0% to 2-3% in a good quarter, that kind of growth rates for our large cap companies. So now when you say lower growth, the worry is degrowth, that they'll start losing business very rapidly. Is that a valid worry?
So let me be very clear. We will not see a decline in revenues for most of the IT companies anytime in next 3-4 years, in my view. What we will see is that lower growth for long. So basically, large caps will do, let's say, 5-6% positive growth. So EPS growth will be maybe 1% higher, 1.5% higher because of the currency and all. So we are looking at 5-6% kind of revenue growth, 6-7% kind of EPS growth for the large cap. For the mid cap, I would put that number at 10-12% revenue growth and 13-14% kind of EPS growth. And the small caps will be also similar. But if you see the multiples, like, the large caps are still at 18-20 times, the mid caps are at 30-40 times, and the small caps are somewhere in between. So I think, at least as a fund manager running my own fund, I will not be comfortable assigning those kind of multiple. And I am very honest, upfront, and disclaimer. Last year we sold everything at, I believe that was the peak, and we sold everything in tech. We have one or two very small position in AI related stocks because there are very few listed ones. And other than that, we are almost zero in tech since last year. And I believe that, still the time has not come where I will be excited to buy. I will give not more than 12-13 times multiple to the large cap, and not more than 15-16 times to the mid cap, and similar to small cap. And I think there is a long way to go there. So we will wait for our turn on that.
Okay, so I mean, you're not convinced. You sold out all your tech. A lot of the mid-cap companies, like Coforge, for instance, some of them had managed to buck this weakness when Coforge was a company that was still managing 30% kind of growth rates up until a couple of quarters back. Now, will they also be impacted Then there was this whole ER&D play in the market for a couple of years. Those companies did better than the large cap IT services companies. So are there any of these safe haven pockets left at all, or you think none of these companies will also manage to kind of survive the storm?
No, so definitely Coforge has been an outlier. Means since when I was covering the stock, the management has done an excellent job. But remember that base have gone up substantially. So there is a mathematics, there is a business model. So mathematically, as you go up in size, it is very tough unless you are the big tech like Google, Alphabet and others, where the business models are totally different. It is very hard to grow the services business on a higher base at the same rate. So definitely, the mid caps, what we call mid cap today, maybe 5 years back, they were of the size of the large cap. So, those companies definitely will not see 30% growth. I think the growth will be more normalized to 12, 13%, 14%. And hence the multiples have to correct. Having on the question on the ER&D, yes, ER&D will definitely do much better than the typical IT services firms. The only challenge is that they are priced much more expensive. And secondly, I think some of the growth, they are also benefited by some of the growth which is coming because of the crisis in the Ukraine zone and all that. So once that settles, I think probably there will be few quarters when there will be a decline in growth and all that, and that may give a better opportunity in terms of multiple to buy. So as of today, I would not like to buy anything in the IT space, mid, small, large. In small, there are some very small AI companies. I don't know if we get reasonable price at some point of time, maybe we'll go ahead with it. But as of now, it doesn't make an investment case. But I am also not negative on the business model. I don't have any view that revenues will decline, employees will lose job and all that. I think that risk is not there.
Okay, so you're not expecting a decline in revenues, but it's going to be lower growth for a longer period of time, and that's why you're staying away. By the way, just before we get, got that point, just before we get to market open, I just want to say that the Nifty has now settled with a cut of 230 odd points. There it is on your screen. And all the large cap IT names have settled with cuts of about 4% to 6%, roughly speaking. Infosys and TCS are down about 6.5%. Wipro and HCL Tech are down about 3.5%. This is how it's playing out. By the way, all these stocks have gone back to multi-year lows. Infosys, I was just looking at longer term charts. Stock has gone back to the 1200 odd levels, which is where it was in May of 2023. So that's how it's playing out. Sandip, there is this other fear that people always talk about, that as AI comes in, and actually all these companies are trying to scale up on AI. TCS started giving out AI revenue separately as well. How do you rate and rank some of those efforts?
No, see, that is the strength of our business model. So I will tell you that last 30 years, I have seen 6 disruptions. And every time what happens, it is a 3-4 quarter of pause when we reskill, retrain our people and we redeploy. So that will not change. See, I don't have at all any doubt that, AI, we have implemented in our organization AI 3 years back. And initially, I was also excited the way you see on social media, a lot of promoters come and they are sharing their exciting experiences. So initially, it looks very exciting. But when you start implementing, when you start seeing the results, when you have to filter, you will realize that the kind of manpower you were using has changed, but the manpower is not going away. So I am very clear that, Indian IT companies will not see any massive employee decline or all those things. We will do good work. It will continue to be good. But yes, the growth rates will falter.
Okay, Sandeep, just hold on. We've hit market opening. Let me quickly, Sandeep's back. Hi, Sandeep. Good to have you back. We still had a few questions. Or have you sold out? Sandeep told us he sold out everything last year.
Yeah. We actually exited. I gave it the same logic because of valuations. We moved out of tech. We were underweight tech and don't hold much. I mean, there are a few businesses which were turnarounds candidates, but largely we were underweight tech all throughout.
Okay, all right. Sandeep, so I just wanted to take final thoughts with you and to kind of wrap this up again. Now, what about valuations currently? Because these stocks have been slammed pretty badly. Worst performers of 2025 and 2026 is off to a amazing start for IT, right? On a lighter note. So given this kind of correction, where are we in terms of mean valuations and how much further to go till the levels that you spoke about? You said you'll only be interested in these large cap IT stocks when they come down to, I think, 15 times forward earnings, right?
Yeah, 1 year forward 10 to 15 times, somewhere in between. Because see, I will tell you the reason. The problem with mean is that everyone is showing last 10-year mean and average P and all that. That is not relevant because the growth rates were different 10 years back and growth rates are different today. So the right way to analyze would, as a means I am an analyst and it doesn't go out from my heart. So right way always will be PEG ratio when you are in a mature industry. So on a PEG ratio, they have actually become more expensive than what they were earlier. So I will not give more than 2 peg ratio or maybe less than 2 peg ratio to an industry which has matured. And so for me 10 to 15 times for large cap and around maybe 12 to 16 or 18 times to mid cap, and that is max I can go. And also remember we have to make money for the investor. So if we give the maximum valuation, how will we make money? So we have to obviously buy at a much lower price. And also remember that numbers are not going to change overnight. You will have to wait after you invest. You will have to wait for at least couple of years before the numbers start changing because there is a disruption which is undergoing. So you will have a lower growth for a longer time and we have to tide through that. So hence, I will not buy at such
Yeah.
current valuation at all.
So just to understand, I completely get your argument. It's a strong argument that you're making that there's no point even looking at past, valuations and look at a 10-year mean because the whole model is very different now. We're looking at real disruption. So I take that point. So the Nifty IT index is about 24-25% off its peak. How much more does it have to fall to get to the kind of realistic, new age, current age valuations, given these business models now?
So there are lot of components in the index which we don't track and which we don't know how to look at. But let me put it this way: I think still broadly on the index side, also 10 to 15% correction is definitely there, and then it is not going to suddenly turn around from there. You have to wait for the numbers to come. So it is a real investment journey which starts.
Okay. Sandeep, before I let you go, just give us something about, you mentioned you're still keeping one or two stocks which have a bit of an AI play, and that's the problem. There are not too many of them. Are you referring to, say, a NetWeb or, what else? And now that you've completely, done away with IT in the portfolio, what would the overall, I mean, beyond IT, what would the larger overweights be for you?
So I will not be able to name you the exact name, but it is not NetWeb what you mentioned. The company which I have invested. It is a very small company, and we have personally checked with them everything. Their technical team. We have done a detailed call with them and all, and we agree. We believe that they do real AI work, and it is at a damn cheap valuation. So we have bought it, but most of the funds won't be able to buy. It is a very small company, but what we love today is the platform. I will tell you, the platforms are phenomenal, and I honestly think that I have a very very contrarian view. I believe our big tech are our platform. You compare them on any parameter. Amazon took 18 years to break even, first dollar of profit. Our Blinkit and other companies have taken much less time and much maybe 5% of the burn which they have done. So we have done phenomenal. You compare with Microsoft, you compare with anything. The problem is that we are trying to compare their big tech with our software services. That is a wrong comparison. I will compare my platform businesses with their big tech, and I can assure you the time and money they have burned, we will achieve much bigger number than them with a much lesser amount of investment and in a much lesser time. So I am very gung-ho on all the platforms, whether it is Lenskart, whether Urban Company, and all of them. And we have investment in many of these platforms for a disclaimer purpose, and I am not recommending anyone to buy or sell. But I think our strength is the platform because we have huge availability of manpower at a cheaper price, and we have a huge population. So I think we will do phenomenal on the platform. That is a structural story in my view.
Okay, that gives us some clues. I know you won't talk stocks, but I think we were getting the drift over here. Sandeep, always a great conversation on technology and always a sector that is getting constantly disrupted. Thank you so much once again for making sense of it all for us. You have a great day and we look forward to being in touch. Thank you so much.
Thank you. Have a great weekend. Thank you.
Okay. Thank you. Yeah, I think everybody can do with a great weekend after a week like this. But Vipul,